Welcome back to your channel. My name is Brad, and today we're going to talk about all high yield ETFs over 10% is a scam, according to a certified financial analyst. If that's what you're looking for, stick tuned. Hey, so my name is Brad, and I've been retired 6 months. I literally live off my distributions. And there's this young gentleman, certified financial analyst, that comes on and starts jabbering about anything above a 10% yield is a scam. And some people in the audience, a few members, said, what do you think about this young man? And I take really disheartening of listening to his video. Very disheartening. One, he's disconnected to retirement world. Now, if you got $2 million, $3 million set aside, he can help you retire. Yes, he can. He can take your money to tell you to go invest in some dividend stocks and stuff like that, and you can retire with $2, $3, $4 million and be happy. And I'm sitting there going, that's great. You're going to charge these people money to give them mediocre advice at best. So what did he call scams? He called the following stocks, or ETFs: JEPQ, FEPI, QDTE, SPYI, and everything else. Calls them all scams. Well, I take a little bit disheartening to that, but it did challenge me. It did. I'm going to say thank you. He did challenge me. So in this, and I'm going to go ahead and throw this out, SPYI has just over 2 years worth of data. And I looked at SPYI and looked at SPY. I took some of my Lean Six Sigma green belt stuff that I'm not going to beat up on the Lean Six Sigma people, but I took the analysis of the correlation. So it's 97% correlated. Then I put some bullion statements and come up with 99.95% correlation to SPY. So now I can take data from 2004 to 2024 and do a correlation between them. And it gave me shocking results because I get to see exactly what happens correlation-wise from 2004 to 2024 with SPYI in the way that I wanted to live. And that is going to be interesting for everybody. But let's get back to what this young man said. He gives the ultimate playbook, cover calls, which his retirement guide, or his ultimate playbook, is cover calls, high yield bonds, business development companies, REITs, and dividends. Okay, at the end of that video that he gives that playbook, he says that you can live off 4 to 5%. That's what he says. You can live off of 4 to 5%. So if you want something close to $100,000 a year, $90,000 a year, you better have probably $2 to $3 million. Yeah, that's what he's saying. And by the way, you can pay him thousands of dollars a year to get his advice so you can live off of a few $1,000,000. And I'm going to say, if you're smart enough to make a few $1,000,000, you can do your own analysis. Just putting it out there. So one thing that I do like is he used high yield bonds and other mechanisms to generate income, because I've always said if you have a bad start, you don't look so good in the future. If you got a good start, you do wonderful. And that's why I tested from 2004 to 2024, because we went through the Great Recession, we went through the pandemic, we went through multiple downturns during that time period. It's a great thing. But I really have a hard time taking advice from somebody that probably wasn't even born during the 1987 Black Monday. I was working at a job. So not only was I born, I was working that day. And I remember 1987, October, and exactly where I was. Because I can tell you, I was in Ocean City, New Jersey working on that day. And I remember it well. We're going to first look at SPYI. We're going to go back and look at the history of SPYI, get some correlation and some thoughts here, talk about other parts of SPYI to debunk this FUD, fear, uncertainty, and doubt by this younger CFA. First of all, there's the CBOE Buy Right Index. We can look at SPYI and how it works against the index. We can clearly see that SPYI is slightly beating the index. Very good. Next thing we can go look at is we can go look at this index. BXM is the Buy Right Index, and we can go back to 2016. So now we have some historical data on how this worked out over the last few years. We know when SPYI started. It's always recovered even after 2 9% downturns. It has. Historically, we know by their share price when they started, comparing it to the market, that it's recovered. Now, does it recover at the same speed? No, it's a covered call. It's an interesting conversation. But clearly, ever since it started, you can take your 8% off of your cost and reinvest the rest. It works out every single month exactly right. Nothing to hide. It works. Now, your balance using monthly instead of getting all the daily goes up over time. This is how it played out when I looked at it on a monthly basis, pluses and minuses, and how it worked out with the account balance. It worked out just fine. And when we looked at income compared to distributions and amount reinvested, you see the amount reinvested goes up over time. You see your income per month go up over time. And this is taking 8% off of cost, not 8% off of worth. And that gets into a very strong conversation at the end of this video. 8% of cost or 8% of worth? Because it plays out differently when I did my back testing of 20 years. And remember, my back testing is probably going to be 20 years at 99.95% correlated. It's probably off by 2%, but always what happens in the past doesn't always predict the future, but we can at least grasp what could happen and what could happen in our retirement. And that's the more important story of this. So I've always thrown up this graph of, hey, if you can make 12%, the market can go down 33%. And if you make 10%, the market can go down 20%. And this is if you're taking 8% off of your distribution. I've always said it. I've shown this chart before. And I went and did the math. If I'm taking 7% withdrawals from my 12, right, the market goes down when I have a 12% payer. SPY on Friday could go down to 348. If I had a 10% payer, it could go down to 418. If I had a 20% payer, it could go down to 209, and I can still collect my 8%. Okay, and I have multiples. I don't have just one fund. I have 12% payer on SPY, 20% payer on SPY. I have multiple plays on SPY, and that's important to understand why. And we're going to get to this. 8%. If I have 8%, you can see if a 20% payer can go down to 239. A 12% payer can go down to 398. Now, I've said this before, and everybody that sits there and they get glazed eyes. They do. It's just, I get it. It's math, and not everybody was good at math in high school. And I hate to say this, this is what I was learning in junior high school. Yes, junior high school, way back in the day, when they actually made you learn something. So how does this look like on a graph? Let's bring up a graph. 7%, if I bought it on Friday, you can see how this plays out. 7% on Friday, you have a 12% payer. the price has to go below all the pricing of the 2022 downturn. If you had a 20% payer, it has to go all the way down below the pandemic. That's how it works. That's mathematically, that's how it works. If I bought it a few months ago and that was my cost, you can see where a 10% payer is and a 12% payer is and a 25% payer. And I just did that for some comparisons. Now, Brad has always said 8%. I'm living on 8% and that's how it is and that's how it's going to be. But doing this testing, I'm going to say there's some new things that you should think about because I haven't stressed it enough to people in some of the processes. So if I'm going to live off of 8%, let's bring up that chart. It can go down. 2022 pricing was. And if you would have bought it a few months ago, you were below what it was in 2022. But you can see the 20% payers are down near that pandemic level. And that is why I have multiple accounts with multiple money being able to make my 8% at different levels. Because I've always stated and stressed that you should have at least 130%. I'm currently sitting closer to the 200% of what I actually need. And in all honesty, even that one number being 7,500 thereabouts, I'm only living on 6. It's about $72,000 a year. I have a little other income coming in, so I'm getting closer to that $200,000 range. So just keep that in mind that if you have Social Security coming in, I mean, my Social Security number is astronomical when I turn 62, in my opinion. I'll definitely be taking it at 62. But I looked at that number going, that's a high number at 62 because that just reduces what I have to take out of my IRAs. And I'm just sitting back going, I didn't think I could spend down my IRAs fast enough just for conversation. At the end of the day, how did this play out? I mean, I've put up great fights so far. If I take 8% and sell shares to ensure I get the withdrawal from cost, this is something that I will not do, but I made sure that I put it out there that 2009, a little bit in 2010, you had to sell a few shares to get your 8%. And you see how it plays out on cost. You're well above $400,000 over the time. And this has started with a $240,000 investment. I bought 5,000 shares and I did the simulation that way. But here comes the most important slide of your life. If you're a SPYI holder, in my simulation, going back to 2004, I'm going to show you taking 8% on cost. You notice that the orange line is distributions and it falls below my monthly income. That's correct. It falls below my monthly income. So I was not able to hold 8% of cost. It was at the worst $400 on this one fund. And this is a 12% payer. And that is why you have high yield bonds, you have business development companies, you have 130% as a minimum, more than what you actually need. You have 4 to 6 months sitting in reserves. So when this happens, you can go right through it and not even blink an eye. That is correct. What you also notice is that the 2020 pandemic wasn't even a blimp. You didn't even come close if you started in 2004. That is the power of compound interest. As these distributions compound, taking your 8%, the likelihood of you not being able to live on 8% gets reduced over time. So the longer you're in retirement, the sequence of return risk goes down. The sequence of return risk is really strong at those first 5 to 10 years. After that, looking at the charts, it really does go down over time because of compound interest. And this is yield on cost. Now, the question gets into what happens if I only took 8% on worth? That came into a different conversation. Because if I take 8% on worth and not cost, you can see how much money you go down, and you go down significantly. But if you look at how much you're making today, it's a different story. You're almost over $4,000 in distributions compared to the other chart where you're sitting right around $3,000 in distributions. And that really becomes the conversation. Do you take it on cost or do you take it on how much it's actually worth? I'm still sticking with cost because going down, you would have to really start digging into that 6 months to make up the difference in cost of living. It's up to you. But you can see how this played out. If you take 8% off of worth, your income dramatically dropped off back in the day. And it dramatically goes up over time. Now, if I take my 8% over worth versus 8% over cost and I put it on the same graph, how does this look like? It shows you what the difference in income. So in 2009, you're taking a hit and you have to live out not 1 year, not 2 years, not 3 years, but you're living out till late into 2015 before you get back off of taking 8% on cost compared to 8% off of worth. That's why I'm sticking with 8% off of cost. Now, will I sell shares to make sure I always get that 8% in a dramatic downturn? No, I will not sell shares. I will hold on. I have right now just over 4 months, and I'm working on that to get it closer to the 6 month. And I will just take money out of that pocket to ride out anytime that this takes a huge dip, because historically, the Great Recession was a long period of time of downturn. Now, I looked at the final version of this. If I took 8% of costs without selling, I ended up with $471,000. If I take 8% of worth without selling, I make up $615,000 today. If I take 8% of costs with selling, I'm at $461,000 today. So that really becomes, where do you want to be in your life going forward? You could have very easily sold shares to make sure you had 8% on cost. You could have. And it will cost you $10,000 over a long period of time. I have money sitting on the sidelines that I don't have to sell. That's my personal comfort level. Now, what this young CFA did talk about was some of these high yield single stocks. And yes, single stocks are more risky. That is just a standard risk curve. Anything that has 1 stock to 5 stocks is a lot more risky than something that has 10 or 20. That just standard common sense tells you that. So let's use some common sense and not just fear mongering about how these things actually work. And let's actually do some financial analysis. I mean, you're a financial analyst. Gosh, how can you be a financial analyst and not actually do any analyst stuff? Did they not teach you that in school? I mean, that's the bigger problem. I guarantee you that was not taught to any of these financial analysts, how they can make a correlation and go back and actually test some of these younger funds. So I greatly appreciate being forced to go do that, because it now shows me how this plays out over 20 years. So I have to make plans now or what occurs in the future. Hopefully you found this entertaining and educational at the same time, and everybody has their own way of doing things. I just don't think that saying that anything over 10% yield is a scam. You have to have some risk in there. So until next time, God bless.